Hey everyone, what if I told you that while most retail traders were glued to the latest blue chip earnings headlines, something far more interesting was happening in the shadows? While the spotlight was focused elsewhere, two of the most influential institutions on Wall Street were quietly building a position in a sub-dollar AI stock. Not a small nibble, not a test trade. We're talking about more than 14 million shares absorbed in a single session. Today, we're taking a deep dive into Dvlt AI, ticker Dvlt. And this isn't just another low-price stock story. This is about timing, positioning, and the possibility that major players are preparing for something the broader market hasn't fully processed yet. The big question is simple. Are we witnessing the early stages of a powerful breakout, or are institutions stepping into a volatility trap that could snap shut without warning? Stay with me, because the next several trading sessions could define the near-term trajectory of this stock. Let's start with what happened on Friday. Dvlt closed at 80 cents, finishing the session up 8.5%. On the surface, that sounds respectable, but that closing price barely tells the story of what actually unfolded throughout the day. The intraday action was intense. It wasn't a smooth climb. It was a battle. The stock opened around 76 cents. Momentum kicked in quickly. By early afternoon, it had surged toward 88 cents. That kind of move in a sub-dollar stock creates excitement fast. Traders start celebrating. Optimism spreads. It feels like liftoff. But then, just as quickly, the momentum evaporated. By mid to late afternoon, the price had plunged to 74 cents. That's a massive swing in just a few hours. From peak to trough, we're looking at a double-digit percentage reversal. Moves like that shake out weak hands. They trigger panic. They force emotional decisions. Many traders likely assumed the breakout had failed. And then something changed. In the final stretch of the session, Dvlt reversed sharply and fought its way back to close at 80 cents. That recovery wasn't random noise. It wasn't a tiny bounce. It was aggressive buying into weakness, the kind of buying that suggests conviction. Here's what matters most. The 74-cent level held, multiple times. When a stock tests a level repeatedly during high volatility and buyers consistently defend it, that level becomes technically significant. It transforms from just a number into psychological support. And on Friday, that support looked intentional. Now let's talk about volume. In the final minutes alone, over 500,000 shares traded. For many small caps, that's a full day's activity compressed into minutes. That kind of late-day surge doesn't typically come from scattered retail traders clicking buy on impulse. It often reflects structured positioning. And this is where institutional activity becomes critical. State Street, Jane Street, these are not speculative hobby accounts. These are global financial powerhouses and both established, sizable new positions in Dvlt. State Street reportedly accumulated over 10 million shares. Jane Street added over 4 million. When firms of that caliber deploy capital into a sub-dollar equity, they're not usually looking for a quick scalp. They're positioning around a thesis, around catalysts, around structural developments. So what are they positioning for? There are two major near-term events on the calendar. First, the February 15th earnings report. Earnings in small-cap AI stocks are often binary events. Expectations, sentiment, guidance, everything can shift in a single release. With elevated implied volatility hovering around extreme levels, traders should expect wide price swings. A strong report could clear resistance and unlock upside momentum. A weak one could send price straight back to support or below it. Second, the Warrant dividend distribution scheduled for February 23rd. And this is where the story becomes more complex. The warrant structure includes a specific ratio. For every 60 shares held, investors receive one warrant. The exercise price is $5, cash only. Fractional allocations don't count. If you hold 59 shares, you receive nothing. If you hold 125 shares, you receive 2 warrants, with 5 shares ignored. Position sizing matters. But the complexity doesn't stop there. To exercise these warrants, holders must meet additional compliance requirements involving digital tokens that must be held in a specific wallet structure. There's a verification period. There are operational steps, and most importantly, these warrants are non-transferable. You cannot simply sell them on the open market. You either exercise them or they expire worthless. This introduces friction. Operational friction can reduce participation, and reduced participation can alter supply-demand dynamics in unpredictable ways. Now, let's zoom out from the mechanics and look at the bigger picture. What does Dvlt AI actually do? The company is building technology designed to bridge traditional media with interactive mobile engagement. Their audio platform leverages inaudible sound signals embedded within broadcast audio. These signals can trigger real-time engagement on mobile devices, things like polls, feedback, or interactive prompts, without the listener consciously hearing anything unusual. In theory, this creates a bridge between legacy broadcasting and modern digital interaction. If scalable and monetizable, that's an intriguing concept. They've also introduced a product referred to as the bias meter, which aims to provide real-time indicators of content slant. In an era increasingly concerned with misinformation and AI-generated manipulation, positioning around transparency and responsible AI could resonate with certain institutional mandates, particularly ESG-focused funds. That narrative alignment matters. Large funds with billions under management often have strict criteria around governance and ethical technology deployment. Framing innovation through that lens isn't accidental. Now let's talk technicals again. Right now, 80 cents acts as a pivot. Holding above it keeps short-term momentum intact. The next major resistance sits near 88 cents, Friday's intraday high. A decisive break and hold above that level could open room for continuation. On the downside, 74 cents remains critical support. It has already been tested and defended, but if that level breaks with conviction, technical damage accelerates quickly. The next logical area could be significantly lower. This is not a low volatility environment. Implied volatility near 70% suggests traders should expect wide daily ranges. Emotional discipline becomes essential. Without a clear risk plan, small caps can move faster than reaction time allows. Now consider ownership shifts. Some early insiders have exited their positions entirely. Full liquidations, that can raise eyebrows, but simultaneously other institutional players have dramatically increased their stakes. Firms like Mariner LLC and Citigroup reportedly expanded exposure significantly. This is what market structure transitions look like. Early participants rotate out. Larger institutions rotate in. Whether that signals confidence or merely strategic positioning is something only time will reveal. So what's the balance takeaway? There are legitimate catalysts ahead, there is confirmed institutional participation, there is technical support that is held under pressure, and there is elevated volatility that can cut both directions. For the next stretch of trading days, price behavior around 80 cents will matter. Earnings will matter, warrant mechanics will matter, and liquidity during high volume periods will matter. If support continues to hold and earnings validate growth narratives, momentum could build quickly toward resistance and beyond. If expectations fail to materialize, volatility could intensify to the downside. This is a high-risk, high-reward environment. Institutions have placed their chips on the table. Retail traders are watching closely. The technical battlefield is clearly defined, and the clock is ticking toward key dates. The only certainty over the next several sessions is movement. And in markets like this, preparation matters more than prediction. This is not financial advice.